Accounting 1 Week 1 mini lecture. I just want to take a few moments here to describe some of the key concepts that you'll learn in Chapter 1 and Chapter 2 during Week 1. Chapter 1 is an introduction to accounting. It's going to define accounting for you as an information and measurement system that identifies, records, and communicates relevant, reliable, and comparable information about an organization's business activities. You're going to identify, record, and communicate are doing that. Identify the economic events, record those events in order to provide a history of its financial activities, and communicate the collected information to its interested users by means of accounting reports. Financial accounting, managerial accounting, and tax accountants are some of the key accounting areas. Financial is area of accounting aimed at serving external users by providing them with general purpose financial statements. General purpose refers to the broad range of purposes for which external users rely on these statements. Managerial accounting is concerned with reporting financial data internally. It's used for business decisions as well as monitoring completion of goals. This type of accounting is customizable and is not bound by general accepted accounting principles, GAAP rules. Tax accounting, accounting methods that focus on taxes rather than appearance of public financial statements. Tax accounting is governed by the IRS, Internal Revenue Code, RC, which dictates the specific rules that companies and individuals must follow when preparing their tax returns. Tax principles often differ from GAAP principles. Real quick, some outside users and internal users of accounting information. Outside include investors, creditors, tax authorities, regulatory bodies, customers, economists, labor unions. Internal users include supervisors, managers, employees, directors, officers, vice presidents, CEO, others within the company that may need this information to present to make present and future financial decisions. Chapter 1 goes into generally accepted accounting principles, GAAP. It's the common set of standards that are generally accepted and universally practiced. It's developed by the accounting professionals. These standards tell how to report individual events. Okay, uh, you have the FASB, which is Financial Accounting Standards Boards, falls under GAAP. Is primary accounting standard setting body in the United States. You have the Securities and Exchange Commission, SEC. That's the agency of the United States government that oversees U.S. financial markets and accounting standards setting bodies. The SEC relies on FASB to develop accounting standards, which public companies must follow. There's also an International Accounting Standards Board. This is for countries outside the U.S. They have adopted these standards. Uh, you're going to figure out and learn about measurement principles under GAAP, cost principle, and fair market value principle. Cost says a company is recording an asset at what they bought it for, their cost. In general, most companies use cost method. Fair market principle says the assets could be reported at fair value only in situations where assets are actively traded, such as investment securities, do companies apply fair value principles extensively. One of the key things in accounting is the accounting equation, which means that assets equal liabilities plus owner's equity. The two sides of the equation must stay in balance. Assets are economic resources owned by a company for future benefit. Liabilities are obligations of a business to pay cash, perform services, or transfer assets in the future. Owner's equity is the ownership's claim to the total assets. An increase in owner's equity would be investments by owner, the assets the owner puts into a business. Revenues, the gross increase of business owner's equity resulting from business activities. Uh, excuse me. Resulting from business activities entered into for the purpose of earning income. You can have decreases in equity by withdrawal of cash or other assets by the owner. You have expenses, which is the costs of assets consumed or services used in the process of making revenue, of earning revenue. On the screen, you see just a couple quick examples. If assets are 200,000 and the stockholder equity is 150, how much are liabilities? Well, that's easy because it always has to balance. So 200,000 minus 150,000 equals 50,000. So liabilities would equal 50,000. Asset accounts, these are some quick examples. These are resources owned or controlled by a company. They're cash accounts, accounts receivable, notes receivable, prepaid, supplies, equipment, buildings, land. Those are assets. And then liability accounts, you have accounts payable, notes payable, unearned revenue, accrued liabilities, and you have some equity accounts, uh, which are owner's capital, owner's drawings, revenues, and expenses make up the owner's claim on the company's assets. That's really high level for chapter one. And real quick, I'm gonna see if we can do a couple of examples. So just kind of to hit home the point of the balance sheet, the balance equation. So let's enlarge in this so you can see it. Look at this little exercise here. The answers are shown, but I'm going to walk you through this anyway. The accounting equation equals assets equals liabilities plus owner's equity. In example A, the assets are 92,000. So we know before we get to the other side, it has to total up to 92,000. So we have 50,000 plus what? 42,000. 50 plus 42 is 92. They balance. This shows it's a blank, so it's kind of fill in the blank is filled in for you. You see the other three answers kind of ahead of time. Spoiler alert. But uh, item B, we have 31,000 and 71,000 liabilities and owner's equity, as, respectively. And you know those two add up to be 102,000. So you see that they balance. This is just showing you this basic concept of the basic accounting equation. 90,000 assets, so you know the liabilities and owner equity have to add up to that. We're given the owner's equity of 50,000, so we know 40,000 is the plug number. Great. All right. Let's try another sample real quick here. On this example, Dorothy is the sole owner of Vista Park. It's a public camping ground near the Crater Lake National Recreation Area. Dorothy has compiled the following financial information for December 31st, 2022. So let's see here. Let me try to get this on the screen for us. Okay. So all this is given here. Revenues during 2022, 207,438. Revenues during 2022 for the general store, 96,310. Accounts payable, 16,299. Cash on hand, $34,079. Original cost of equipment, 156,319. Fair value of that equipment now is 207,438. Notes payable is 88,902, and expenses during the year was 222,255, and accounts receivable is 25,930. With that information, they want us to prepare a balance sheet as of December 31st. So this is kind of given to us as well, but I'm gonna walk us through it. The cash, all you have to do is you see the cash on hand is 34,000. This is listed in order of liquidity, like what can be converted to cash the quickest. And cash, of course, is already cash, so it's at the top. Cash is king. So cash is given 34,000. Accounts receivable is next, and you see accounts receivable 25,930 as listed here. Equipment, do we list it at the cost or fair value? We list that at original cost. In the slide, we talked about original cost, and 156,319 is the original cost. You total that up to get the total assets, and don't forget the total assets is going to have to balance out with the liabilities and owner's equity. So let's see what the owner's equity is. We have the notes payable of 88,000 as shown. You have accounts payable 16,299. That's the total liabilities of 105,000, but it doesn't equal 216,000. So we know the owner's equity is going to balance that out of 101,127. So that's how you complete a balance sheet given this information here. Uh, it asks for the balance sheet, and notice the revenues wasn't listed on here on the balance sheet. The fair value of the equipment is not listed on here. It was the original cost that we needed to know. Expenses was not listed on here. Revenue expenses because those are income statement type items. And then here's a few journal entries as an example that you probably should know how to do. The following selected transactions by Bryce Company are presented in journal form. Eventually, we're going to need to post these to T accounts uh, to show the ending balance. So, okay. So on May 5th, accounts receivable was debited and service revenue was credited 5,100. That was for the bill for it. There was a bill for service performed. So we're going to have an accounts receivable T account. It's right here. All right. This T account shows a debit because debit just basically means left. Credit means right in accounting. So on May 5th, we see the 5,100. On May 5th, it was also credited to service revenue. See that? On May 12th, cash is debited, accounts receivable credited. Where's cash? 4,700, May 12th, debited. 4,700, accounts receivable credited. On May 15th, for received cash for services performed, you have to debit cash 3,900 and you credit service revenue. So we see the debit to cash on May 15th, and on May 15th we see the credit to service revenue. You total up the debits and credits, you get 8,600 cash debit and then balance. Total up the accounts receivable debits and credits, they net to 400 debit account at the end of balance. Service revenue totals up to 9,000 credit in balance. And cash and accounts receivable, those are assets which the normal balance for assets are debit balances. But that's just some high level information I wanted to share with you for chapter 1. Thank you for your attention.